Benjamin Carmona joins me here today. You can learn what his team is up to. Head over to perchwealth.com and you can learn what's going on there. But really appreciate your time, Benjamin. We're going to be talking about your syndication efforts and what's going on in your world. But let's start things off because before we hit record, we were talking about more times than not, a lot of people get into real estate investing accidentally in a variety of different paths. But based on your background, it sounds like it's very deliberate and you found your way early. Can you talk a little bit about that?
Absolutely. Well, first of all, thank you very much for having me on the podcast. Very much appreciated. Great to meet you and speak to your audience. So many people, they don't know what they're going to end up doing in life. And that's one thing I did know. I grew up in kind of a real estate family, if you will. My father was in the foreclosure business. He's the owner of multifamily, a private lender. And at a very young age, he brought me into the business. I had a passion for it. So I always knew I wanted to be in real estate and investments. I didn't know I was going to end up in the niche business that I'm in today, but I definitely, there was no ifs, ands, or buts about what I was going to do at any time.
Sure. Well, let's talk a little bit about what Perch Wealth takes care of and what you are working on. What is the expertise and what do you focus?
Yeah, absolutely. Thank you for the question. So I'm a financial advisor. I'm not, so I'm securities licensed. I'm not your traditional advisor that's doing stocks, bonds, mutual funds, annuities. My expertise is in private real estate syndications. Most of our business is done on the 1031 exchange. I don't know if your audience is familiar with 1031 exchanges. Some are, maybe some aren't. Our clientele are those baby boomers and seniors, primarily 60, 70, 80, 90 years old. These folks have accumulated real estate and managed it for the most part all of their lives. They're older now and they're hoping and dreaming and praying of a solution or a structure that will allow them to sell their property, get out of active management, right? Transition to passive management, defer taxes via the 1031 exchange, and collect stable, predictable income. We specialize in those types of passive investment structures, which qualify or satisfy the 1031 exchange. One of which, the popular one, is like Delaware Statutory Trusts.
So that makes a lot of sense. You know, people are transitioning and they're trying to find something a little more passive. Are you then looking at a number of syndications to participate in on their behalf since you're a financial advisor?
Absolutely. And so that's what we do when a client comes to us and they, we speak to investors or prospects or clients, from as somebody that's thinking about selling their property in 2 years. We're talking about educating about 1031 exchanges, how they work, the guidelines, the timelines, and then obviously educating them on the structures that we offer that may appeal or may be appropriate for them. But yeah, in my world, and this is a niche business, at any given time, there's maybe 100, 110 different syndications available in the market. And I'll just throw out some big names that are the participants, which may resonate with some of you. But like, I'm talking like Cantor Fitzgerald or Starwood or Apollo or Ares or Jones Lang LaSalle. And there's 50 of these sponsors, if you will, or syndicators that are active in our business, providing, structuring these DSTs. And then it's my role and my team's role to bring the very best opportunities to our clients relative to their investment objectives and current financial situation. And the last thing I'll say on that front is prior to starting Perch Wealth with my business partner, who Gersten, 4 years ago, I spent 15 years on the investment syndication side. So I worked with the Cantor Fitzgeralds. I worked with several other bigger companies involved in everything, acquiring the real estate, structuring whether it be private REITs or Delaware Statutory Trusts or TICs or business development companies or funds, educating and training financial advisors like myself or wealth managers or attorneys and CPAs. So I know the industry incredibly well. And so essentially we're recommending the very investments that I was manufacturing for 15 years. Just like any business, There's a lot of options out there. They're not all great. And especially when you're dealing in an industry where not only are you dealing with a lot of money, many clients of which it's the biggest part of their portfolio, and it's a highly fragmented, totally untransparent marketplace. And that's where we come in and guide the best we can. A lot, John, but
Yeah. Well, that makes a lot of sense. So let's kind of try to put things into order here. You're right. Some people may not be aware of what even a 1031 exchange is. Could we kind of give them like a summary version of that, like 1031 exchange 101? Like,
absolutely. And again, audience more than welcome to call us. I can get into the details of the nitty gritty, but in a nutshell, IRS code 1031 exchange allows, and it's been in the code for 100 or more years. It allows investment property owners. I don't know why my screen keeps going up. Investment property owners to defer taxes. When they sell their property, they can defer taxes on any gains as long as they exchange into other like kind or investment, property. So it is the most powerful tax code out there, in my opinion, in terms of generating and preserving wealth. Reasons why investors are in real estate, because you can buy a property today, hold it at value, appreciates, hopefully you sell it. You don't have to pay the taxes as long as you exchange, and you can continue to exchange and exchange and exchange, never pay tax. And then one day you pass away and your beneficiaries inherit that asset way down the line at, if you bought it at $1 million, it's worth 30 million. I'm making this up, obviously. You pass away and all the taxes that you've deferred between the 1 million and the 30 million, they get wiped out, and your children or your beneficiaries capture that wealth at a stepped up cost basis, right? So that is the premise of an exchange. That's the power of an exchange. Of course, the IRS has blessed us with this opportunity to defer taxes. They don't make it easy per se. So there are rules and timelines that need to be followed to accomplish it. But that's the 1031 exchange in a nutshell. And if I can dig deeper if you like.
yeah, why don't we do that a little bit? It is kind of interesting that there, especially around the rules associated with the like kind and the timing of this, because if you don't have something identified and figured out, that timing can evaporate really quickly.
Amen. You said it. Okay. So first we'll start with, I mentioned like kind. And this is one of the biggest, even folks that have heard of a 1031 exchange or even thinking about doing a 1031 exchange, they hear this like kind. So if I'm selling a multifamily investment property, I need to buy a multifamily investment property. That's not the case, right? The way the IRS describes it and the way it's done is it's just investment property for investment property. So if you're selling a multifamily, you can buy raw land as long as it's considered investment property. You sell a multifamily, you can go to a hotel or hospitality. And so really it's not sector by sector. It's like kind, meaning investment property for investment property. The biggest thing, as you mentioned, Jack, is it really comes into play when you sell your property. You have 45 days to identify suitable replacement properties, right? So 45 days. So you sell your property, you have 45 days, and within that 45-day period, you can be identifications as many times as you want. But once that 45th day expires, the properties that you've identified are the only assets that you're able to exchange into. So you think 45 days sounds like a lot of time, but not really, right? That means you have to find suitable replacement properties. You have to do your underwriting, your due diligence. If you need debt, you need to go out and secure the debt. You get all that together in it's 45 calendar days. So let's just say you identify 3 properties that you want to go into. You could go into 1, you can go into 2, 3, or none at the end of the day. But 45-day expires, you've identified 3. 2 of them, you thought you had them locked down, financing was locked in, boom, they blew up. I mean, they didn't work out. So then you're down to 1. And sometimes, maybe that 1 that you identified only captures or represents a portion of your exchange amount. So anything that you don't replace is going to be taxable. And that was a very choppy explanation. Let me say it this way. The IRS says If you sell a property for $1 million, you need to buy real estate of equal value or more. So you need to buy at least $1 million of real estate. 45 days to identify. Once you've identified, you have an additional 135 days from that 45-day period to close on those replacement properties. And so the timeline can get dicey, right?
Mm-hmm.
Especially if you line up all these things. And that's where the products that we offer, then all goes away, right? Assuming you want to be passive, the offerings that we provide or recommend are already owned. They're stabilized, they're income producing, all the due diligence and underwriting has been done. And you can simply slide in and own a fractionalized interest of $100 million multifamily in Dallas, Texas, or a $200 million medical office campus in Orlando, Florida. So they're turnkey.
Mm-hmm. Well, that makes it, that sounds like you're fitting in the need there, especially in those situations when they only have 45 days. Before we jump into your underwriting, how you vet these investments out and a few other things, I want to remind everybody, head over to perchwealth.com for more details to see if this is a good fit for you. If you found some value in what we're talking about so far, do us a quick favor, share this with one of your investor friends. If you're watching us on YouTube, give us a quick like and subscribe. So, Benjamin, can you kind of give us some insight as to what your team does? Because you have to be vetting and reviewing quite a few syndications to make sure that these are good fits and they're producing what they're promising.
100%. And that's what's crucial. And that's where the value comes in. So in our business that, if you're doing a direct exchange, or forget about even exchanges, if you're buying a piece of property, all of the traditional things that you would do to underwrite or conduct due diligence on that asset, of course, it's the tenants, the surrounding market, right? The supply demand fundamentals, new inventory coming in, the price per square foot, all that stuff. That's just taken for granted. But in this space, as an investor, when you're investing in a passive position, you're giving up control. You're giving your money to a sponsor and you're trusting them to operate and manage that property efficiently and prudently. Our due diligence starts at the sponsor level, right? I want to make sure that whoever I am working with or recommending, I need to make sure that I can substantiate their credentials, their track record, their history, their wherewithal, the capitalization, all those components come into play. So it's really starts at the sponsor level for us. Then we get down to the real estate itself. And then, the fees, right? The fee structure, right? What are the fees in this deal from start to finish? Is there an alignment of interest with the sponsor company? Are they just putting out a property and they don't have any skin in the game? I don't like that, right? And so, the sponsor, the real estate, the fee structure, and just the viability of the investment strategy. I don't care what they're paying today necessarily in terms of an income stream. I need to make sure that after 5 or 7 years, when this thing turns, when it sells, that there's a viable investment strategy to create value for my clients, not only for them to get their money back, but hopefully appreciation. So there's a couple of additional levels of due diligence or underwriting that are involved in these. And again, I'll just go back to the 15 years I spent on that side. I know sponsors, most of them, the CEOs on down. I've seen how they've treated investors in good times or bad. Have they stepped up to the plate in challenging times? Have they not? So there's a lot of intangibles that come into play in this arena. And again, that's where we kind of shine because we know the players.
Mm-hmm. Can you talk a little bit about how things might have changed over the past few years, especially with the pandemic and our current economic environment?
Sure. Absolutely. It's amazing. Who would have thought, obviously, the pandemic was coming and then the real estate just went kind of through the roof, minus a couple of sectors. And now we're in this period of time where the markets are still going through it, right? There's still a tremendous amount of uncertainty. Office is struggling, will continue to struggle. I think there's a push to get people back to offices, but we're still going through it, in my opinion. What's happened in the last couple of years in at least, Jack, we talked about what sectors do you invest in before we started. And given the nature of our clients that have already really made a lot of their money, they're not trying to get rich, they're trying to stay rich per se. And so everything we do is from we want to invest in defensive, resilient sectors that are poised to perform in good or bad economic times. And so that's industrial, it's multifamily, it's healthcare. Believe it or not, I love, oil and gas mineral rights, which I'm happy to discuss later. But to your question, what's happened? Everything is held up pretty well. I will say on the multifamily front and even on the self-storage front, there's been a lot of inventory added to the markets, right? The reason being is the last 10, 12 years, this low interest rate environment, developers have gone wild, right? Naturally, they're borrowing money at nothing they can put out and so that created a situation where there's a huge pipeline of deliveries. And that pipeline was delivered primarily in 2022, 2023, and 2024. There's a little bit coming in the beginning of 2025. So that has created downward pressure on, at least from our perspective, on multifamily and self-storage in terms of rental rates, occupancy. And so some of our investors are in deals that have reduced distributions, right? If they were at 5, maybe they're at 4, or if they're at 5, maybe they're at 2.5. But I'm still very optimistic in those sectors because once the excess inventory gets gobbled up, which will happen, it should happen in the next 18 months, the pipeline for new inventory has gone way down with the spike in interest rates and construction costs. So they'll get gobbled up.
That made sense. I mean, we're just in a completely new world, and I hate to use these anecdotes, but, looking in my own backyard, we're seeing a lot of commercial property that was built during the pandemic that are still vacant today. And I don't know how they're ever going to, what use they're going to eventually be.
Sure. I mean, some of them can be renovated or transitioned to other sectors, right? We're starting to see a little bit of that, right? Some assets can go to storage or multifamily, but yeah, we're in this period of still very much uncertain period of time.
And so was it kind of an interesting exercise? I would imagine that those syndicators that actually knew what they're doing and were bracing for what was happening. I mean, cream rises to the top.
There's no doubt. And in fact, I would tell, because I've been through this, right? I've been in this business since 2006 and I saw the heyday in 2008, 2009. The sponsors were robust in terms of the amount of them participating in this industry. I think it got up to 50, maybe 55. And, I was saying a couple of years ago, you just wait. When things get tough, that 55 number is going to drop to 30, right? And I think that's what you're alluding to. And those are the 30, obviously, that we want to be investing with, that have the wherewithal and the capitalization to weather these storms. But yeah, we're still in that period of time. We're still going to see some drop. There's still a lot of, uncertainty, interest rates and debt maturities coming due. What is going to happen in the world? We have a new administration in place. We got the tariffs and this and that. Who knows? And that's why, again, it's, in my opinion, it's all about protecting the downside right now. It's not time, in my opinion, to be jumping into opportunistic type of investments, really predicated on our client profile.
Mm-hmm. Well, can you kind of share like some successes? Have been some of your biggest wins? Maybe even something that surprised you.
Oh yeah, absolutely. No, I appreciate the question. I'll tell you what makes our job so gratifying is that we're really able to help people. And this goes to the question about success. A lot of our investors, baby boomer seniors, that have held real estate for so long, these folks do not want to manage anymore. They're over it. They don't want to do toilets, tenants, trash, right? They're just sick of it. But they're worried about selling their property and having to pay tax, or maybe they want to do an exchange and they don't find the property in time or blows up and they have to pay tax. And then also if they sell the property and do an exchange, what does it do for them if they sell a multifamily property here and buy another one, down the street? They still have to be involved in management. So the success is really what we do every day is I say little Mrs. Smith that owns a $3 million property in Orange County, which is where I'm based, California. And, she's owned it for 30 or more years. She's fully depreciated her assets. So she's no longer even sheltering income. She's probably earning 1% to 3% income based on current property values today. And she doesn't want to manage. So she sells her property. I can remove the fear of having to pay tax, right? Because I have options right now today. I can relieve her of her responsibilities associated with active management, improve her life, free up time to hang out with her family and grandchildren. I can, more times than not, increase the amount of income she's earning. And in some cases, increase the efficiency on that income in terms of adding new basis and sheltering incomes. And so the success or the good news, that is the great news. Of course, there's risk in all real estate investments. There's no denying that. But the big thing, and I totally missed this, is the Delaware Statutory Trust, you're allowed up to 499 investors. So it's fractionalized ownership, and the minimums are low because you can have so many investors. So the minimums are 100,000 or 250,000 each. So Mrs. Smith that sold a $3 million property, I could put 250,000 into a 400 unit multifamily project in Dallas, Texas. 500,000 into a storage portfolio in Raleigh, North Carolina. 700,000 into a medical office campus in Orlando, Florida, and 250 in oil and gas and mineral rights. So I'm able to diversify, mitigate risk, increase income, remove the fear of having to pay taxes, and then give our clients the opportunity to spend more time with their family. That's the success.
Yeah, you typically see, and you're encouraged to do this type of diversification in your 401ks and your IRAs and
Yep.
everything else, but you don't see it as frequently in the real estate investing world. So over how many years have you been doing this now, Benjamin?
Almost 20.
20.
Yes.
Along the way, you've likely have learned a number of lessons the hard way. Is there anything that comes to mind initially? Like, what is the biggest lesson learned?
Yeah.
Maybe even the most expensive lesson learned?
Absolutely. No, I mean, it's all about lessons, right? And learning. I'll tell you, there's been a handful, but when I got out of college, San Diego State, I was a spring chicken, obviously, in this world of real estate and securities. And I walked in 2006 before the market crashed, and it was like amazing. I mean, this is the best thing ever. We were making money. We were having fun. We were helping clients. I mean, our biggest issue at that time when things were rolling was keeping our fax machine full of paper to keep up with the amount of paperwork that we're coming in. I was like, wow, this is amazing. But then the market hit, right? And people got clobbered. And that was devastating for me, devastating. And that is what changed me for sure. I went from a kind of happy-go-lucky sales guy having fun, again, amateur, to, okay, I need to understand what the heck is going on in these syndications. Right? I need to understand this. They're not all great. They're not all good. The sponsors aren't all good. I need to figure this out because I do not want to be involved in this business, recommending investments to clients that I care about and have things go horribly wrong. And so that was a major, definitely a blessing in disguise. It was early on in my career. And of course, there's been other items throughout my career, working with sponsors, lots, a myriad of issues. And I take those with me today. And again, it's not an ironclad guarantee that you're not going to lose money with us, right? I would never say that. You don't know what you don't know. But I've definitely honed my skills through these experiences to really mitigate risk the best I can.
Before we jump into the rapid fire questions, I was going to ask you, do you happen to have a story of somebody who came to your company through the needed services maybe they didn't know what to do, or they're kind of stressed around the timeline for this 1031 exchange, and how you mitigated that and the positive outcome.
And you broke up for 1 second there, but an investor that came to us in a time crunch, you know,
Yeah, just kind
oh,
of share a customer success story.
sure. Yeah, there's so many. I mean, there's so many. But look, there are investors that love the passive structure, right? They come to us, they know what they want to do, and those are all, for the most part, success stories. But maybe you, Jack, you're young, you're nimble, you're still shaking and moving. You do not want to
I'd
be in a
like you to continue to tell that lie to everybody, but
and you don't want to go passive, but you're on day 42 of your 45-day ID period. You're out of luck. You're facing a major tax bill. And you feel like you're done. Those clients come to us too. They stumble across us, or DSTs in general. And on day 44, 45 even, we can get them identified with their qualified intermediary, which is where you need to identify these properties. And we save them a ton of taxes, and they end up, they're thrilled with the income, the passive nature of the investments. That's just one, that happens I don't want to say all the time, more often than you think.
yeah. Well, it's got to feel comfortable for them to run into somebody who, you know, I told you before that I typically deal with distressed homeowners. And when you have these type of conversations, there is something reassuring when you tell them that, you're not new to the situation. They're not alone. This has happened to other people before. It's kind of comforting, and it helps to reassure that they're on the right track now.
Absolutely right.
Before we jump into the rapid fire questions, is there a question or concept you think we should have tried to hit on?
Look, for the topic of this, I mean, I talked about the 1031 exchanges. We talked about these passive structures that are out there that are widely unknown. And I'm talking widely unknown by the most sophisticated real estate investors, CPAs, attorneys, you name it. I mean, they're unknown. But they're in the tax code 2004-86. That's when DST created and validated. I would say, Jack, that if you look back to 2008, right, when the market cratered, and I would say, investors that did everything right. They had cash, they diversified, they did their old traditional 60-40 bonds, stock portfolio, they did real estate, they kept debt low. They still got crushed, right? They got hammered. Everybody got hammered. And then you think, okay, well, I did everything right. I still got my butt handed to me. Here we are today, fast forward, for the most part, everybody's come back, right? Real estate's come back, stocks have come back, bonds have come back. And today you think, all right, well, many of our clients are thinking, how do I avoid, especially with all this uncertainty, how do I avoid a 2008 situation, right? And then it takes you think about, okay, well, in 2008, who did okay? Who were the players that did fine? And it's the institutions, it's the endowments, it's the big boys. Okay, well, what did they do? Well, they had 50% of their assets in what you consider like alternative investments today, right? Those non-traditional mutual funds, stocks, bonds. And so I guess the message, and I bring this up because the DSTs are within underlying umbrella of what you would consider alternative investments. And so today, my message is to investors, look at alternative investments, right? Whether it be 1031 exchange related DSTs or not, but other private income producing investment strategies that are not tied to the stock market and they're not tied to the bond market. And we advise on that stuff too, because I used to do a lot of it. But that would be my message. And it's a powerful message. I think investment client portfolios by and large are underweighted for sure in alternative investments, or perhaps they don't even exist in a portfolio. And that is a great way to reduce volatility and a way to diversify, to be in a position to survive whatever's coming. Hopefully nothing, but who knows?
Sure. Well, I appreciate that. Well, if you're ready, we're going to jump into the rapid fire questions, close out this episode. Before we do, it is perchwealth.com, perchwealth.com. That's going to be a clickable link in the show notes. But if you're ready, Benjamin, we'll jump in and close out this episode.
Hopefully I perform here. I'm a little nervous. No, hit me. Let's go.
The first one is, what lie do real estate investors often tell themselves?
Higher income equals a better opportunity, right?
There you go. Yep. No, great one. If you could go back in time and give your younger self a piece of advice, what would it be?
I would have gone out on my own earlier. It's incredibly scary doing that. I would have done it earlier. So I encourage everybody to just trust in God and yourself and pull the plug earlier. Do it on your own.
Sure. Do you have a book recommendation, or what are you reading right now?
So funny. I'm not a huge reader. I'm constantly talking to everybody at the ground level, brokers, lenders, investors, sponsors. And I always go, I mean, this is just, I always say, and I know it's ridiculous, but Rich Dad, Poor Dad, I mean, that had a huge impact on my life. And so I don't have anything current I would bring up.
And then finally, what single strategy or tool have you implemented that has had the biggest time-saving impact to you or your business?
That's a good question. And that's still a work in progress, my friend. I will say learning how to delegate. Delegation, it's very, very difficult to do. It's still difficult for me to do today, but I've been doing that a lot more and I need to, and it's been wonderful. And I need to continue to do that.
Sure. Well, I really appreciate the value you brought here today. It is perchwealth.com, perchwealth.com. Check out what Benjamin's team can do for you there. And really great to meet you. I appreciate it and hope you'll consider coming back sometime.
Oh, I love it. Thank you so much, Jack. And thank you to your audience. Hopefully we'll talk soon.